Hey, what's up, everyone? My name is Chris Hendricks, and today's segment will be about protecting your accounts from big losses, rather, in case your analysis goes uh, the wrong way. So, I'm just quickly gonna jump into the TradingView platform. Um, so, I have specific charts that I'm gonna look at. Basically, it's what I am trading this week. And the first chart is Australian dollar against New Zealand dollar. And with these pairs, especially the ones that have like big relations with the EU, uh, you should consider watching the news as well, because these might be influenced. So, as I know, Australia rather, it is sort of like independent from the EU, but then they still have close relations. But the thing is about Australia, it has more ties with like the Asia countries and stuff. So I don't think it will be impacted that much. So okay, let's just jump into it. With this one, I'm just gonna jump to the 4 hour time frame because this is just to show you how to protect your accounts from major losses instead of like breaking down everything basically. So as you can see, current market, the 4 hour time frame, we had a huge impulse to the upside, correction right here, and impulse, and then now we have this correction, which is uh, it looks good because it has cleared points. As you can see, that's our support there, and we have resistance over there. And with our theory of consecutive series of three touches, right there, with the third one having the highest probability. So basically, we enter the third touch right here, and as you can see, it's been rejecting. So I just want to show you where I caught this setup. I'm just gonna jump into my Google Drive. Uh, as you can see, we have it right here. So I think this was the okay. This was the 3 hour time frame. So you can see with the 3 hour time frame, uh, we I entered right after the first bullish candlestick to the upside closed in the 3 hour time frame. So the second candlestick was my entry point. Uh, so that's just to give you a bit of context. So if I jump into the 3 hour time frame, so basically I took my trade uh, around these areas, and it's been buying since. So this was rather a risk entry because this is a big structure. It's more or less of a structure than a flag or a pattern. So we're still gonna have a pattern or a flag. So I didn't enter aggressively because this was a risk entry from this point. So I'm just waiting for a flag like this to form, and then that's when I'm gonna take aggressive trades from that point. So but then let's say you prefer the risk entry, you want to be first, and you wanted to enter where I've entered. So let me just get something to highlight that area. So basically around these areas, around those areas. but then you fear that the market might reject to the downside. Um, and let's say you have your stop loss around these areas. So the rule is to look at the candlesticks, right? Because the candlesticks, they say so much, they give you signals. So you can see how the market got to the support. We had this reversal candlestick right here. I'm not gonna say the names of these candlesticks because I forgot. I learned them a long time ago. So there's this reversal candlestick, and then the following candlestick reversed to the upside. This is a bullish candlestick, right? And as you can see, it engulfed this one and the previous one, so which means this was a strong, the combination of these two candlesticks, it was a strong confirmation that we are turning. And if that was not enough for you, you could have scaled down to the 2-hour time frame, and as you can see, rather the same thing happened, but then the bullish candlestick, the first one was a bit small, and then you had a series of 2 bullish candlesticks, which is also confirmation. So if the price turns, rejects. So the first, this drawing is a bit sketchy. So the market turns. What you should be looking at is a series of 2 uh, candlesticks that are the same, going to the same direction. So with this one, you would have waited for this reversal candlestick, and then this bullish one, and then the second bullish candlestick, and then that's when you could have entered as well. As you can see, that's where it closed. Remember your stop losses around these areas. Um, so that confirmed a buy for you. But then, okay, now let's say from this point, the candlestick went and sold off and closed around these areas. So it broke this trend line. So what you should have done is, since you were waiting for these candlestick confirmations, if they had sold to the downside, it would have discouraged you to enter because there was no confirmation. And that's how you usually protect your trades. But then if you've already entered as a risk entry, you could have just put your stop loss around these areas. And but then since we had perfect candlestick confirmations, the price didn't even break the support, it didn't even get any close to your stop loss. So that is how you would take a trade and basically protect yourself from losses. So I'm just gonna move on to the next chart. Okay, before I move on to the next chart, I want to show you the same concept. So with this one, it is Euro ZAR. It's been selling off, and as you can see, we with this bearish structure, we had clear touches on our resistance. So you take your trade on the third touch, highest probability, remember. So I'm just gonna zoom in and show you guys the concept of candlestick confirmations. So I'm in the 2-hour time frame right here, and if I zoom in to our third touch, you can see once it touched and closed, the next candlestick was it reversed. It's a bearish candlestick. It engulfed the previous candlestick, which was this makes it, the combination of these two make this a reversal confirmation because of the engulfing candlestick. So the series of two two candlesticks that are the same, this one and this one, the combination of these two, the same consecutive bearish candlesticks confirmed this whole thing here, this engulfing. It confirmed the turning of the market, so it reversed. So you would have entered right after this second bearish candlestick closed, so right here. Let me just get the pattern position. So you would have entered right there, and just look at what happened after. The market never went back to the stop loss or anything. It just went straight down, and as you can see, it's been going straight down. And I was looking at this trade I think last week. Let me just get a clear picture. So this was the flag that I was just talking about, right? 1, 2, 3 touches, and then prediction of it going or selling off. And as you can see, it sold off quite aggressively without going to our stop loss. So the prevention of you going into losses is basically knowing the reversals of candlesticks and what they mean. You need to really dig deep into candlesticks, and because that's your signals, that those are your confirmations of your setups. So you can't just take a setup based off your trends. You also need to see how the candlesticks are reacting to those trend lines. So this was your result. So I'm just gonna jump back to New Zealand against the dollar and check out the setup. I'm gonna jump into the 4-hour time frame and work from there. So this is a pair that I'm trying to execute. So I'm just gonna show you how I'm gonna protect myself from taking losses with this pair. So I'm just gonna have this double top right there, and I don't have to put the lowest low. You guys should know that this is the lowest low. So I'm just gonna jump into the 1-hour time frame. So the price kind of like broke out and went back in. So basically, this is considered as a fake breakout. That is a fake breakout. So if you're trading support and resistance, and you wanted to take this trade as a buy, like, oh, it broke out this zone, and now it's retesting, which it looks like it did right here, and it rejected or reversed. So you would have entered aggressively with like buying positions, and it just went back inside, suffering from major losses. Okay, so from that point you can see this is a huge impulse to the downside, and now we are in this corrective phase. As you can see, we have distinct points right there. You can see that is our resistance, and we have our support right here. So with this trade, It's the same concept. It's always the same concept. Three touches, which is one, two, three. So at this point, we are supposed to be looking at reversal candlesticks so we can execute a selling position right here. So I'm just gonna jump into the 30-minute time frame and show you. So if you were aggressive and entered after this selling candlestick, this bearish candlestick, and thinking, oh, it's definitely reversing without waiting for further confirmation, you would have been in losses right now. As you can see, it's buying. It's buying. So waiting for those candlestick formations and confirmations, it is quite necessary. So don't even scale down to the 15-minute time frame, because you would think this what do you call this, morning star candlestick with the combination of this bearish engulfing candlestick, you would think this is enough confirmation for you to now sell. But then remember, the smaller your time frame is, the less influence it has. So you would need to stick to the 1 hour time frame for those reversal candlestick formations, depending on the scale of your structure. So this is not a big structure or pattern or flag. 1 hour time frame reversal would be enough. But then scaling down to the 15-minute time frame, you saw that you had false reversals, or reversals that had no effect. So right now, all you have to do is just adjust your trend line to predict where it's gonna reject. As you can see, if I line it up like that, the price hasn't really touched my trend line. So even if it does, I'm still gonna wait for those reversal candlesticks within the 1 hour time frame, and okay, the 2 hour time frame with this small flag is I would recommend you stick to the 1 hour time frame. So basically, that is how you protect yourself from taking huge losses, by preventing taking trades that will reverse and go the other way instead of going your way. So the best prevention of taking wrong trades are looking at candlestick reversals, because those candlesticks, they give you signals on whether to take a trade or not. Even though your analysis is good, it's up to point, everything makes sense, but then without the addition of those candlestick confirmations or reversals, it still puts you at risk for taking that trade. So it is best to learn these candlestick formations. And what I like about candlestick formations, it's not such information that is like a secret. You can get it on the internet. You can just search candlestick reversals patterns or something along those lines, and you'll definitely get a picture of different flags with candlesticks with descriptions and pictures. So that is it for today's segment on how to protect yourself from taking losses or taking bad trades. Uh, it
It
is
is
the
the
key
key
is
is
candlestick
candlestick
formations,
formations,
because
because
those
those
candlesticks
candlesticks
they
they
give
give
you
you
signals.
signals.
They
They
confirm
confirm
your
your
setup.
setup.
So
So
that is
that is
it
it
for
for
today.
today.
Thank you
Thank you
so
so
much
much
if you
if you
watched till
watched
the
till the
end.
end.
Make sure
Make
you
sure you
like,
like,
subscribe,
subscribe,
and
and
till the
till the
next
next
one.
one.
This was
This was
Chris
Chris
Hendricks.
Hendricks.